Hello, this is Bob Steele. In this lecture, we will continue on Chapter 12. We're going to move to organizing a partnership. So this organizing the partnership is, of course, the startup of the partnership. We're going to start up the new partnership. So when we think of starting something from scratch in having two individuals come together in order to have a business plan for the future, the aspects will include partners can invest both assets and liabilities into the partnership. So we can think of any asset that we're going to have. Basically, we might have a building that we want to have the partnership in, and we want to input that into the partnership so that whatever the fair market value of that building is, we're going to put that into the partnership. We could, of course, put cash into the partnership. We could also put liabilities into the partnership. So if the building costs $100,000, but there's a $40,000 mortgage on it, both the asset of the $100,000 building and the $40,000 mortgage, the liability will go into the partnership as well. And notice once it goes into the partnership that both partners are now responsible for both the asset allocation as agents of the partnership, as well as the liability. So those are things to consider when we put in information or assets and liabilities into the partnership. So assets and liabilities are recorded at an agreed upon value, normally the fair market value. So this valuation idea we've been talking about when we talk about fixed assets and things like that, if someone puts a building or a car or a forklift, something like that into an organization, into a new partnership, the question is, how do we value that? Let's say it's like a forklift. How do we value it? Well, we could say, well, they purchased it for this amount, 50,000 or so. The individual who put it into the partnership may have depreciated it. They may have a book value. But when we are negotiating, we want to put it in there at the fair market value generally, because what we're trying to do is come up to what we think the value is so that we can give proper allocation of value to the partners who have put in the information. So the two partners are basically kind of doing a fair market value type of transaction, meaning once it goes into the partnership, both people are now responsible for the partnership agreement, and therefore we're kind of making an agreed upon like fair market price, similar to a sales transaction, as to what we believe that piece of equipment is worth when you put it into the partnership, so that the allocation of resources in the capital accounts are correct. So we're going to put all the assets in there at fair market value. Of course, if it's cash, it's not a problem. But if it's anything other than cash, like a building or a forklift or some kind of property, plant, and equipment, we need to get that allocation. We may have to do an appraisal if it's something large, such as those things. So at-risk contribution increased the partner's capital account. So the easiest journal entry to think about is when we're starting a partnership from scratch. If someone puts in 10,000 cash, we debit the partner's checking account for 10,000, and we credit the partner's capital account. So before we had a sole proprietor where we only had one individual, where when the individual started the company, they may debit the cash and credit their owner's equity capital account. Same idea here, except now we have two capital accounts. We have two partners at least, or more, and if they put money into the partnership when we first start off, you can think of the most basic journal entry being debit cash to increase cash, credit the capital account, representing that the partnership now owes that cash back to the owner. Withdrawal from the partnership decreases the partner's capital account. So there's nothing new here. This is the same thing we did with the sole proprietor. If the individual took money from the company, that's fine. It doesn't affect the income statement. What happens is cash goes down with a credit, and then we would debit the capital account, reducing the capital account. So if the capital account had a credit of 10,000 and the individual now drew money out so that they can use it for their personal expenses, and they drew 2,000 out, we would debit the capital account by that 2,000, bringing it down to an $8,000 balance. So nothing changes there. It's just a little bit more complicated from the bookkeeping side, because now we have to account for two different capital accounts, and it's very important to account for those correctly, because that represents basically the amount of money that's kind of owed from the company on a book value term to the owners, the partners. So here's the problem demonstrating this. On January 11th, Kayla and Hector organized a partnership called Boards. Zayn's initial investment, $7,000 cash, $33,000 in boarding facilities, and a note payable for $10,000 on the boarding facilities. So then Perez's initial investment was 10,000. So let's actually look at Perez's first, because that's the easiest type of investment. So Perez just put in 10,000 cash. We know what's going to happen to cash then to the company. The company then got cash in their checking account. Cash is a debit balance. We need to make the debit balance go up, so we're going to do the same thing to it, which in this case would be another debit. So we're going to debit cash, making it go up. And then we have to credit something. We're going to credit something by that same amount. And we're going to credit the capital account, kind of like owner's equity. It's partner's equity in this case, for Perez, who put the money in there. And we know that capital accounts have a credit balance. They represent the amount of money owed back to Perez. Therefore, we're going to increase it with another credit by doing the same thing to it. So now the company has 10,000 in it, and we owe that 10,000 to Perez, which makes sense because Perez put the money into the company. Now the other is a little bit more complicated, right? Zayn put in 10,000 cash, so we're going to debit cash in the same fashion. No problem there. They put in boarding facilities, so that's going to be the facilities that we have. And once again, we agreed on that price, the value being 33,000. That's an agreed upon price. We may have had to do an appraisal to do that, but it is an asset, and therefore we're going to debit the asset for 33,000. And then there was a note in relation to the boarding facilities, a note that has the boarding facilities basically as collateral on the note for the most part, and that's 10,000. So now both partners are now assuming that liability. Both partners are assuming that liability within the partnership. And therefore, a liability has a credit balance. We need to put that credit balance on the books. Credit balance have a credit account. Therefore, we do the same thing to it to make it go up. We're going to increase the note payable, the liability, by crediting 10,000. The difference, the 33 plus the 7 minus the 10, the asset plus the asset minus the liability, would give us the capital account that Zayn would put into the company. Which makes sense because we put assets of 33 plus the 7 minus the liability that is no longer Zayn's liability only. It is now the partnership's liability. And so therefore we have a credit increasing Zayn's capital account by the 30,000 in this case. So organizing a partnership. In accounting for partnerships, partners withdrawal are debited to their own separate withdrawal accounts. So remember when we withdrew, when we had an owner's equity, and a single owner, that we made a draw, and the draw was against the capital account. So now we of course have two owners. We got to keep those two owners' draws separate. So we're gonna have two draws types of capital accounts, and those two draw accounts will then roll into those partners' individual capital accounts. And so we need to, in essence, net income is going to increase the capital account. Any more investment by the owners, the partners, will increase the capital accounts, and draws will generally decrease the capital accounts. We just need to make sure that we apply it to the correct partner in this case. 2, partners' capital accounts are credited or debited for their share of net income, net loss, when closing the accounts at the end of the period. So at the end of the period, we have the closing journal entries, which I believe was chapter 4 type journal entries. When the income statement closes out, we have to make all the income statement basically zero so we can start the next year or the next period. And we closed out net income to the owner's equity account when we had a sole proprietor. We still need to close it out. Now we need to close it out to the partners. So if there was 10,000 of net income, we close out the net income, and if they split it evenly, we would split that between and there was 2 partners, between the 2 partners, 5 and 5. Now again, it doesn't have to be split evenly. It could be split in any number of ways depending on the partnership agreement, but whatever that net income is needs to be allocated to the partnership accounts in accordance with the partnership agreement. Each partner's withdrawal account is closed to the partner's capital account. Separate capital and withdrawal accounts are kept for each partner. So this is the same idea as the sole proprietor we talked about. It's when the withdrawal accounts, when the partner withdraws from the partnership, we're going to enter that into a separate draws account, which is going to be an owner's equity type account, which will have a debit balance. And in the closing entries, just like we did in chapter 4 for the sole proprietor, we'll close those draws accounts into the capital accounts. It's just that now we're going to have at least 2 of them, or however many partners we have, we'll have a separate capital and a separate draws account for each. So we need to know, we have LeBron and Durant organize a partnership on January 1st. LeBron's initial investment is $1,005. consisting of 350 equipment, 1,650, and a note payable reflecting a loan for the new business, 5,000 durants. Initial investment is cash of 8,000. These amounts are the values agreed by the partnership. So they agreed on these values. Prepare journal entries for LeBron's investment and Durant's investment. So the first one, all we do is we say what assets went on there. He put in cash, so we're going to debit cash, increasing cash. He put in equipment. We agreed on the value of 1,650. We debit to increase that. Then there's a note payable. Notes payable have a liability. Therefore, we're going to increase the liability by 5,000. The bad thing is going up in this case. The difference, this plus this, the assets minus the liability that LeBron put on, represents the capital account that is now owed back to LeBron in essence. All right, and then Durant, once again, fairly straightforward journal entry. Durant put in 8,000 cash. So therefore cash is going up with a debit. Cash is a debit balance. We're going to make it go up by doing the same thing, which again would be another debit. Then we have to credit something. That credit will go to the capital account. Capital has a credit balance. If we credit the capital account, we're doing the same thing to it, which will make it go up, which makes sense because it represents the amount of money that's basically owed back to Durant. And all he did was put in that money. We haven't done any business yet. Therefore, the company clearly owes Durant, if the company were to close or the partnership was to close right now, the 800 back. Now, once we do business, of course, these capital accounts will go up by net income, hopefully. So if they're splitting it 50-50, each time we allocate the net income in here, that would increase these capital accounts. It would go down by the draws. So of course, what we're hoping to happen now is the company makes money, their capital accounts go up, 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 and then when they want to use it for their personal use, they draw it out. And hopefully they don't, and what we don't want to see happen is for them to draw out more than is being allocated to them within their capital accounts, or else they'll have a negative capital account, which basically represents that they owe the company money.